Good morning. Welcome to the Trends to Watch Beyond Cross-Dock E-Commerce and Warehousing Distribution. My name is Steve Schellenberg. I'm Vice President of Supply Chain and Logistics Business Development for IMS Worldwide from Houston. And we put together a panel this morning that is going to change the subject a little bit for NAOP members, but I believe we'll have some real value to add to the conversation. Before we start, I want to make sure that you're aware that the session is being recorded. So if you're going to ask a question, if there's time at the end of the session, please use a microphone that's available so that we can have the questions recorded. First of all, I want to thank Lang Cottrell and the conference committees for allowing us to have a little bit of rope, get out on the limb a little and talk about a subject that's different from the typical conversation here in LA about the big box and the warehouse distribution facilities. And also a thank you to Claudia Avila for helping me with the panel, for putting together some of the work products. There you are. The conference brochure says that this is a conversation about trends to watch. Things that are going on in the industrial sector that are not about the big box, the fulfillment, and the e-commerce. So the question today is, what are these trends and what regions and cities and states and country and parts of the country are impacted? And what's the path of progress as we look at our energy industry? Start with the natural resources and the growth and the availability of energy products and what that means to the country. And by the way, I'm from Houston, and it's not just a Texas play. It's not just a Houston play. Yesterday in Bloomberg, if you read the article, the U.S. has taken Russia's crown as the biggest oil and natural gas producer in a demonstration of the seismic shifts in the world's energy landscape. That's a big deal for us in the United States, in Canada, and Mexico. Our panel today will look at the impact of the chemical and the energy sector on the economy, on GDP, and jobs. Specific markets, specific growth industries are occurring and are becoming more competitive because of this availability and the strength of our energy industry. But as you will hear, it's not just a conversation about the U.S. There's significant opportunities and growth in the industry in reshoring and manufacturing already occurring in Mexico. Our friends in Canada, as you will certainly hear when you go to the conference later this year in Vancouver, will be proud to tell you about their energy industry and its impact on their economy. But when you look at the energy booms, it's occurring in Pennsylvania, in West Virginia, in Colorado, in Wyoming, in Louisiana, in Ohio, the Dakotas, and obviously in Texas. So it's really a national conversation. Let me start with two things, a chemistry lesson for you. And I'm not going to take too much from Owen, just a minute on the chemistry lesson. Polyethylene and polypropylene are two products that are the result of the chemistry of refining natural gas. Very simplified, but in reality, in the next 5 years, we're going to add 22 billion pounds of new production of polyethylene and polypropylene in the U.S. 22 billion pounds. A lot of that will be exported. For you who watched went on a tour yesterday, that means somewhere around 400,000 containers of product will need to be exported from the U.S. That's full containers, so if I do my multiplication, one container is 2 TEUs, that's 800,000 TEUs will need to be exported from the U.S. each year over the next years to get that plastics to the world. When I run the rest of that math, that means about 40 million square feet of warehouse space will be required as export centers. That business is already starting to occur on the East Coast. Charleston, Savannah, and Norfolk already have activity relative to exporting. One of the benefits there is that they have good rotations to Europe. They have strong rotations through the Panama and the Suez Canal. There is a second canal, you all know, and it's very, very strong. Larger ships are running to the East Coast already. But it's also happening in Houston, in Dallas, in Freeport. And there are folks looking for that needle in the haystack here in LA and Long Beach for a place where there's rail-served infill and access to the heavyweight corridor where you can spot up a couple hundred rail cars of bulk resin to transfer to the containers. The facilities that are being developed for this are to 400 to 500,000 square feet. They have requirements for 200 rail car sidings next to or in close proximity. And one of the best benefits for the development of rail-centric and port-centric is that they are also required to be able to load heavy. So our panel today is going to talk about a number of different pieces of the equation. And I'm going to introduce the panelists only by name and by title, and then they're going to present. So you'll have four presenters right following each other. No introduction, no transfers. First is Owen Keene. He's the Senior Director for the American Chemistry Council. Second is Luis Gutierrez, President of Prologis in Latin America. Third is Dr. Thomas Tunstall, Research Director for the University of Texas in San Antonio. And then we'll wrap up with Eric Foster with Avis & Young. He's the Principal and Practice Leader for their industrial capital markets. So we've got a lot of energy on the table here. Let me turn it over to Owen, and we'll start the program.
Hi, I am Owen Keene with the American Chemistry Council. We are a national trade association based in Washington, D.C., and I'd like to spend a couple of minutes talking about how the explosion in natural gas production in the United States is rippling downstream to industries like ours. Let me start by describing the chemical industry. It's an $800+ billion enterprise, employs over 800,000 people, and chemistry touches 96% of all manufactured goods in the United States. We are a very energy-intensive industry, and particularly natural gas intensive. So the fortunes of the chemical industry in large part rise and fall with the price and availability of natural gas. These are good times for the chemical industry. We are in the midst of an unprecedented growth in natural gas production in the United States, primarily from the shale formations that are found across the country, largely in about 6 or 8 different basins. The biggest one is the Marcellus in Pennsylvania. A couple of years ago, it was producing 2 billion cubic feet of natural gas a day. Today, it's producing more than 16 billion cubic feet a day. So the growth in natural gas is meteoric, and it is attracting a great deal of attention from around the world, from chemical manufacturers who are seeing what is emerging to be a decisive competitive advantage. Just a quick look at the gray line is U.S. natural gas prices relative to other gas prices around the world. As you can see, we are enjoying a tremendous advantage in cost, and by all accounts, that cost advantage will be long-lived. This illustrates how a few short years ago, 10 years ago, we were the high-cost producer of chemicals in the world. Today, we're at the low end of the production scale, and the rest of the world is taking notice. As a result of this growth in natural gas production and competitively priced natural gas, the industry has responded by announcing that some 225 projects are either under construction or in the pipeline, valued at over $138 billion, poised to create about almost 400,000 new jobs and expand economic output by $266 billion. This is all happening in the United States. It's happening today. It started a couple of years ago. The wave will probably crest around 2017, and will continue into the next decade. It's a diverse investment wave, heavy concentration on the Gulf Coast because of a lot of logistical built-in advantages. That is the center of the North American chemical industry. But we're also seeing strong growth in investment in the Ohio Valley, which is close to our customer base, and in the Midwest. You look down, you go down a little further downstream, and you'll notice that there's been a similar wave taking place among our customers, the plastic processors, and this is a more geographically diverse group. There's more than 460 projects in the pipeline that are based in more than 40 states, with a heavy concentration in the Midwest, upper Midwest, and in Texas. But for the most part, this what's happening in the chemical industry is largely an export story. More than 60% of the new investments in the U.S. chemical industry are coming from foreign direct investment, and our economists at the American Chemistry Council estimate that about 65% of the incremental or new additional output that will come from these new production facilities will be exported around the world. This is based on a study that we did last year that shows the anticipated destination of those new exports. By 2030, we expect to see a net increase of $30 billion in U.S. chemical net balance of trade. So just to wrap this up, the shale gas wave is having a very positive influence on the chemical industry and other energy-intensive industries. We're poised for almost $140 billion in new investment, with a heavy emphasis on export growth. I come from Washington. We're a public policy shop. So from our standpoint, our interest is maintaining on keeping this pipeline open, and ensuring that there's good permitting processes in place so that both the facilities that can get built in a timely fashion and also the infrastructure that moves the natural gas from the fields to the factories. So thank you very much.
So good morning to all, and thanks to NIOP, Tom, Claudia, for the invitation. It's great to be here. It's been a while, and it's good to be back. So I'm going to try to cover some of the, and give some perspective of manufacturing trends. I run Latin America for Prologis, so I do Mexico and Brazil. And I just want to let you know what's going on in manufacturing in Mexico. It's a big trend. It's a big partnership with the U.S. too, and just want to cover that. Companies are trying to manufacture closer to the market, and manufacturing is having a shift from global to regional, and the North American region is benefiting from that, and that is U.S., Mexico, and Canada. And of course, energy is a big driver going forward, but it's not the only driver of that shift. Some technical problems here. Okay. All right. So Prologis has been doing business in Mexico the last 16 years. We have the largest quality real estate portfolio, 32 million feet. What are the difference of the Mexican portfolio to what we see in the U.S. is that it has two strategies. One is the logistics strategy, and the other one is the manufacturing strategy. About 65% is dedicated to logistics, mainly in the main cities in Mexico City, Guadalajara, and Monterrey. But we take advantage of the manufacturing trends, and we're also located in the border markets mainly. The driver of manufacturing is the exports. Manufacturing exports have been booming. NAFTA was signed 20 years ago, and that free trade agreement was the shift of the Mexican paradigm. And now Mexico is a manufacturing powerhouse. Just to give you some perspective, Mexican manufacturing exports are the largest of its kind, and it's $355 billion. And of course, a lot of the products that are assembled are from US imports, and Mexico imports about $300 billion. So there is a huge partnership on the manufacturing side. So the way we do manufacturing in Mexico, I mean, you always think about specialized buildings. We try to orientate our buildings to tier 2 suppliers and flexible buildings. So these are logistic buildings that are adapted for manufacturing tenants. And that's where we do it. And it's interesting, we have demand from a lot of sectors. Of course, the one that has the most dynamic is the auto sector. In our warehouses, there are assembly of wheels, bumpers, car seats, wirings, in all geographic. But we have aerospace, we have electronics. Very close to here, we have Tijuana. Tijuana is very high on medical devices. In our warehouses, they do peacemakers or they do prótesis. So, there's a client in a hospital in Los Angeles that needs a specialized prótesis, so they, send information, it gets done in a warehouse and gets shipped back there at a very competitive cost. Electronics also is very important. The IBM campus in Guadalajara, for example, we make the Bose speakers that are sold in the United States in one of our warehouses. White goods and, stuff like, the Callaway golf clubs are assembled in Monterrey, or the BlackBerry devices are also assembled in one of our plants. So, a lot of good stuff happening in those. So, as I said, regionalization versus globalization. Globalization began, I guess, when China met, the World Trade Organization in 2002, and there was a big trend. China got, a lot of the manufacturing down there. But now, after the crisis, things have really changed. After, the economy has been turning back, there's a lot of decisions on where to manufacturing, and there is a lot of factors. Of course, labor cost is one of the big factors, and China cost has risen. And I think, the North America cost, and we have a graph there a little bit, so you can see how, the US labor is very competitive, and also, of course, the Mexican labor. Transportation time, more than 30 days to bring stuff from China. And of course, what happens here is not so much the cost of transportation, but the cost of inventory of the goods. There was a big event, which was the tsunami. I'm sure you guys remember that very well. And that had a big disruption of the supply chain, especially the Japanese car makers couldn't supply, the U.S. and it lasted for more than 6 months. And that, when the economy turned, have made the Japanese companies change all their manufacturing decisions to manufacture closer to the market. So that was very important. Technology changes, technology and the consumer, e-commerce is making the consumer to be very demanding, and they want their product the way they want it, and they want it in one day. So that is shifting production closer to the market. And then, of course, we have started to talk about energy, and that's going to be a big shift on manufacturing. This graph is very interesting, and this was produced by the Boston Consulting Group, and this is the end of 2014, and you can see the production index, and the difference in, by countries. And, I would like to point out, the USA there, the electricity and gas, how lower is it compared to the other countries. And then the overall index, it's very interesting. So you can see that production and that the US and Mexico as a bloc can be very competitive going forward. Here is what's going on in Mexico a little bit. These are some of the main sectors. I think it's, of course, our geographic location closer to the US, the biggest consumer market in the world, is a big driver. But also, 40 different treaties that boost, it's the same if you produce a car in Aguascalientes that you produce in San Antonio, because you don't pay any duties, and that has been a big driver. Mexico, throughout this last 20 years, has worked on that importantly. And in these 20 years, you can also find a lot of suppliers. So, there's been a huge base of suppliers in the chain, and that's why people are shifting production closer to the market. And then, I would say in that order, is the labor force. It's not only about cost, it's about finding it. It's about having the right engineers and the right training, and you have a lot of clusters that have been formed in the last 20 years. So here you can see, which are some of the main clusters. The auto parts, and Mexico is the #1 exporter of auto parts to the U.S., where they get assembled here. Aerospace, medical devices are, important sectors. And of course, the big winner is the auto sector. Mexico is now the #7 manufacturer in the world, #1 in Latin America, the 4th exporter in the world, and the #1 supplier of parts to the U.S. The plan is we manufacture 3.3 million cars, and the plan is to reach 5 million cars by 2020. And of course, 40% of the car is of parts that are produced in the U.S. So this is a trend that is going forward. This year we have had several announcements, and I think there's more to come. The whole car industry is having a big shift, or where they produce. And the other very important thing, and it was just beginning to touch, is that there was a reform. In Mexico, you could not, it was a monopoly by the government, so they opened up the constitution, and now there is possibility to co-invest with the private sector. And there's a lot of interest from foreign companies to come into Mexico and take advantage of this. Of course, the first revolution will not be in oil extraction. It mainly will be in gas, the pipeline of gas, which will, lower the electricity cost, and we will make the region much more competitive. The second one is going to be shallow waters. Shallow waters, in Mexico, it probably about $15 per barrel. So, the barrel is about 50 or 60. So I think, there's a lot of room to grow, and there's a lot of people interested to tap into that opportunity. And, what is going to take a little longer is the deep water. As, with the current pricing, it may not make a lot of sense. We do have a lot of resources right south of Texas. They have not been exploited, and there's a lot of U.S. companies trying to tap into that opportunity in Mexico. Lastly, so what does it mean for real estate? So manufacturing demand is probably about 50 or 60% of the overall demand in Mexico. It may be about 25 million square feet of demand a year in diverse markets. Most of the demand comes from multinational companies taking advantage of this trend. As you can see, all the car companies are multinational companies, and their suppliers are multinational companies. Their contracts are US dollar denominated. Cap rates in Mexico are between 7 and 8%. This compares to the US, maybe, here LA, maybe 4.5%. to 6%. So there's a wide gap of about 200 basis points of a Class A warehouse with a Class A multinational tenant, a U.S. dollar-denominated contract, the U.S. way. So there's a lot of U.S. companies, developers, trying to take advantage of that. So thank you.
Dispense with this. All right, moving right along. Steve, I forget, do I have an hour or an hour and a half here? An hour and a half. Okay, good. All right. I'm going to start this off with a quote from a great modern-day philosopher, Yogi Berra, who says that in theory there's no difference between theory and practice, but in practice there is. I'm at the Institute for Economic Development. We're sort of what you might call economic development extension at the University of Texas at San Antonio. We try to bridge that academic or theoretical side on the one hand with the policy-making world or the real world in which most of the rest of us operate. And so our research hopefully is read not just by other academics, but by policymakers and planners as well. I did my dissertation on outsourcing, the nature of outsourcing, so I just wanted to kind of highlight some of the, it's not always good news when you do decide to outsource, and I just on this slide kind of highlighted some of the potential pitfalls and some of the reasons that we are seeing reshoring occurring back here in the U.S., in addition to just the energy itself. What's happened here recently and unexpectedly, a decade ago, companies were spending billions of dollars along the Gulf Coast to develop natural gas import terminals, and then suddenly we found ourselves awash in natural gas here in the U.S., and now they're spending billions of dollars and more to convert those to export terminals. We believe our analysis suggests that the price of natural gas, while in the past has been highly volatile, certainly from 2000 to 2010, and thus made it difficult to plan to use natural gas if the price spikes are going from $2 to $14 per thousand cubic feet. That situation has changed, and we expect natural gas prices to be in a very stable range, probably between $3 to maybe $7 at the most per thousand cubic feet. The U.S. now produces more natural gas than it ever has, over 25 trillion cubic feet annually, and we expect that to continue to increase. Oops, going the wrong way here. Just in terms of crude oil production in the U.S., we're producing almost as much as we ever have. Not quite. I think we hit 10 million barrels per day in 1970. We're at 9-point-something million barrels per day, and that number may continue to go up. As I mentioned, we're producing over 25 trillion cubic feet of natural gas annually in the U.S., and so a lot of projects are being driven toward the U.S. because of this low-cost natural gas that we have available. U.S. companies are relocating here, I guess, partly because of the wages may be more expensive here, but the natural gas more than offsets for that. It's driving projects back here. This is the chart I mentioned where natural gas prices have traditionally been very volatile, and that's no longer so much the case. Right now they're trading for about $3 per thousand cubic feet, and so we're seeing a lot more applications for natural gas. A lot of power plants are using it to generate electricity and moving away from coal, frankly, which is good news from an air quality standpoint. We're seeing lots of manufacturers use natural gas as a feedstock. Fleets have been converting to natural gas for a long time, but now we're seeing refueling stations popping up more and more, and vehicles, long-range vehicles being used to run on natural gas. And of course, as I mentioned, export is now a significant topic. This just kind of highlights how, again, I don't want to spend too much time on this, but the volatility of natural gas and the fact that the coldest winter we've had in a long time, 2013 to 2014, the prices of natural gas didn't really go outside of the range we had mentioned, whereas 10 years earlier, they did spike up when we had a cold winter. Case study I want to touch base on is Corpus Christi. They're seeing a huge impact as a result of the low price of natural gas here in the U.S. This is just sort of a schematic of the bay. The port itself is actually sold out of available land, and so a lot of projects are being put in place on the north side of the bay over between Portland and Ingleside. A lot of that is a result of the activity in the Eagle Ford Shale And I just wanted to kind of highlight, I did bring some copies of our most recent economic impact report on the Eagle Ford Shale. They're out on the table out here if you'd like to pick one up later on today. This is the port area. And Ingleside and Portland up at the top there, there's some rural area between them, but over the next 10 years, the city managers there believe these cities are essentially going to grow together and that area as well will be developed. But this sort of just gives you an idea of the many projects that have been put in place. We talked to the city manager of Ingleside a couple of weeks ago. He indicates that there's about $38 billion in projects being put in place. An analysis that we had put together 2 years ago in one of our Eagle Ford Shale economic impact reports suggests that along the Gulf Coast there is currently about $100 billion in projects being put in place in large measure to take advantage of the low cost of natural gas that we have here and expect to continue to have. And then this is just an example of a natural gas processing facility out in South Texas near Cotulla, again, a direct result of the sort of the change in the landscape. A lot of infrastructure has had to be put in place in South Texas, other parts of the U.S. to support the activity. This is a picture of a rail spur near Cotulla, which is about halfway between San Antonio and Laredo. 5 years ago, it looked like this. The old joke was that if you wanted to find it, you would have had to use a metal detector to do it. It's been transformed into this rail hub that brings in sand, barite, where pipelines aren't in place yet. They're taking out crude oil, and so it's literally been transformed. And so just to kind of highlight what we see as some trends, aside from the fact that we haven't had a market correction in a while, so we think the road ahead could possibly be a little bumpy. We're a little concerned about China's overbuilding. They actually have some really interesting ghost towns being developed there, and we're not sure if that is in fact sustainable. I think it's very possible that oil prices could still go lower before they do come back up, but it's interesting to note that the shale technologies, as we apply more techniques such as big data analytics and the fact that the E&P companies use standardized parts as opposed to the major oil companies, which can have as many as 328 standards for valves alone. Their cost structures are significantly different than in the past and will be driven down further to the point where some analysts think that in future years we actually could be producing shale oil and gas competitive with what's produced in Saudi Arabia and Qatar. And by the way, one of the points I want to mention earlier was just that the U.S. is actually the country that has the second lowest price for natural gas worldwide, second only to the Middle East, Saudi Arabia and Qatar, and they don't have the manufacturing infrastructure or workforce that we do. And with that, I'm going to relinquish the remainder of my time and move right along.
Thank you. Good morning. I'm Eric Foster. I lead the practice for our industrial capital markets for Avis & Young. And if you're not familiar with Avis & Young, we are a full-service commercial real estate services firm with 66 now offices across the globe. So, Steve, thanks for having me up. So, when we think of manufacturing, I'm going to talk a little bit about manufacturing in the United States and its impact with regards to capital markets and investment. When we think of manufacturing, we typically think of a chart that looks like this. So trending downward, not a lot of employment. My dad worked for GM for 40 years, and in the 80s and the 90s, I remember that it was a tough road to hoe for a lot of manufacturers. But when we think of this, this is emblematic of what's going on within our manufacturing facilities across the U.S. So a couple of data points that go beyond this chart. The U.S. is still the #2 exporter of manufactured goods across the world. Manufactured jobs have also declined over the past 40 years, and a lot of that is due to our facilities and technology improving. So back in 1970, 1 in 4 persons worked in manufacturing. Now it's only 1 in 10, and many of those have switched from unskilled to skilled labor. From 1980 to 2012, across the whole economy, output per hour worked increased about 85%. In manufacturing, it's increased 189%. And over the past 45 years, the proportion of manufactured workers that have some college education was 20%, and today it's more than 50%. So we've got a greater workforce that's more educated in facilities that are more specialized. So I'm a capital markets guy, so I got to touch on cap rates and interest rates. As you can see, looking at 2007, the U.S. cap rates were just below 7%, and interest rates, or the 10-year Treasury rather, was in the mid-4s. That spread being about 2.25. Today, that spread, although cap rates are similar, the 10-year today I think was around 240. This chart's a little bit dated, but that spread is huge, right? Almost 4.5%. This is one of the reasons why industrial has a lot of favored nation status among investors. Also, we're seeing rent growth and a lot of good development, but yet restrained development in many markets. Next slide, I want to talk a little bit about warehouse manufacturing and vacancy rates. If you look at the trough, which is 2009, the warehouse vacancy rate in the U.S. was just under 10%. Today, it's at 6.8%. Manufacturing has been pretty steady. It's 7.2 at the trough in 2009 to 6.8, almost 7% today. It's a pretty steady performer. A lot of build-to-suits, not a lot of people go out and build or create manufacturing facilities, but it has been a pretty steady performer for a lot of owners and investors. Next chart is a little bit about rents. As you can see, we're well off of peak when it comes to manufacturing facilities, but approaching peak with regards to warehouse. I think we still have some runway with some of these manufacturing rents throughout the U.S. So this is where things get a little bit interesting. We start talking about investment volume. The first row is 2007, which is pre-recession to 2014. And the warehouse investment volume change in that period of time is 17%. In manufacturing, it's down almost 30% from pre-recessionary levels. But from the trough, everybody's improved, right? Warehouses really come off the bottom quickly, 500+%. Manufacturing, 300%. In 2013 to 2014, and this is, I think, beginning a bit of a trend, you've got warehouse up 11%, and manufacturing really starting to come across the curve. We took two states, California and Texas, and looked at industrial and manufacturing from peak to trough. And if you look at the first column, industrial in California, the investment volume is off a little bit, about 20%. The manufacturing is off 36%. Actually, industrial in Texas probably being driven a lot by Dallas and Houston, up about 16%. Manufacturing off about 38%. But look at the trend line in the middle, or the numbers in the middle. If you look from the trough, 2009, okay, manufacturing in Texas is off the charts. And then if you look just the next row over, look at the manufacturing trends from in California and in Texas. A lot of manufacturing growth in those two states. So as an industrial capital markets guy, do I think that a lot of investors are going to be microscopically focused on manufacturing facilities and adding manufacturing facilities to their portfolios? Maybe. I still think it's a big box world, and a lot of the institutions and the larger players need to have bulk distribution in their facilities, in their portfolios. But what I do think is that this is a trend that we are seeing in specific markets and submarkets that investors and owners should be taking advantage of. Thank you.
Well done, well done. Thank you very much for your comments and for your input and for your thoughtfulness on the subjects of how the manufacturing and reshoring and shifts in industrial opportunity exist. We have some time for questions. And I want to go back to the beginning of the topic and say to the NAIOP folks that the reason I asked for and gave my right arm to the conference committee for this session was because I wanted to make sure that while we live and breathe big box in Southern California, there are things that are going on around the country that are significant. They impact jobs, they impact economic development and economic opportunity in markets that are not typical of the places where the big boxes live. And that's the point I really wanted to make when I asked for the opportunity to stand up this session. Let me ask a couple questions of the panelists, and then we'll have a few minutes open for you guys if you want to have some questions. Or I come from Texas, so we call it you're allowed to cuss and discuss as long as we're above the line, knowing we're being recorded. So Owen, first of all, for you, let me sort of pitch a question your way. A year ago, when we started talking with the NAIOP conference group, oil was trading at above $100 a barrel. Today, it trades in the 50s and the 60s, and I want your input and your comments on the notion of does that volatility move the target in terms of some of the projects, the time frame for the projects, or are these downstream far enough away from the exploration cycle of the oil and gas that these projects actually are still going to get done?
Yeah, thanks. In our world, the United States chemical industry is largely a natural gas-based industry, and the rest of the world it's largely based on petroleum feedstocks. So last year we had a ginormous competitive advantage over oil-based chemical operators around the world. Even with prices contracting by 40% or more, that advantage has gone from ginormous to enormous. We still have a decisive competitive advantage in the United States, which is why you see so many foreign-owned companies coming here to build their next facilities.
Okay. And Luis, one of the topics that comes up when people talk about Mexico is the notion of security. And I stepped away from that where there was a request to talk about that specifically in the conference, and I said we'll talk about that on the panel. You live there, you work there. I had a lot of experience in my career in Mexico. A lot of my friends still work on the border and are very successful and have very strong businesses. Tell us about where you think the security issue is in Mexico, and is that a compelling reason not to invest in Mexico? Clearly, the tide of investment suggests otherwise.
Thanks, Steve, for the question. And well, I would like to mainly conclude that with the topic that security is getting much better, and that a lot of the security around Mexico is a bad perception of what's going on. But this cartels, and talk about a little bit the origin of what happened. You may remember all of this TV series on Miami Vice, and all of the drugs coming from Colombia came, through the Gulf, through the Miami route, and that, got shut off by the U.S. Authorities. And then I guess the cartel or the drug lords started to look at different routes, and I guess the one that had the best way out was through the border of Mexico, and going by land and not going by sea as it used to be before. So through time, the drug cartels started to get, because these are like multinational companies, they have a lot of power, and they have a lot of money. And so they, with also the smalling of arms from the U.S., arms in the U.S. are free to trade, and there's bad guys that smuggle over the border. That made, the cartels even more powerful. So there was a fight, between territories, and that happened, across the border towns, when the economic crisis hit, because, these trends also have to do with economic cycles. And we saw, very bad images of Mexico from border towns right when the crisis hit, 2008, 2009. I think, both governments have been working, first not to let arms, go on the south of the border, but also with a lot of intelligence to dismantle these cartels. So a lot of good work has been done. So what I would have to say is, bad places or places where it was bad in Tijuana, Juarez. We have had operations there 16 years ago when we opened. We have people working there on the ground and we have a lot of jobs that are, in our warehouses. So violence is between cartels, and the situation in the border is much better now. In fact, employment is back. Our occupancies in the border towns are between 95 and 98%, so they are at very good levels, and things are evolving in the right direction. There is some noise, and that is geographically located mainly in the southern states of Michoacán, Oaxaca, and Guerrero. And, I think the trend is good, the economic cycle is good, there is a lot of jobs, and that is helping, of course, security. And I would have to say that Mexico, there are some cities in the U.S. that have worse ratios than the Mexican ones.
There you go.
Hey, Steve, I just wanted to add, we recently completed a preliminary study on the shale opportunities for Mexico, so it's mostly in the northern part as relates to energy reform. And yes, security is an issue in Mexico, but the energy companies operate in far more hostile environments than that, Nigeria being a prime example. It's interesting also to note, though, that aside from security, Mexico is going to have to deal with issues related to infrastructure, pipelines, roads, other facilities that aren't in place yet the way they are, say, in Texas or California, to take advantage of the prospects that energy reform offer. Mexico remains the fourth largest country in terms of automobile production, I believe. So, I think the story for Mexico is very positive over the long run, but there certainly are some near-term challenges they'll have to address.
Okay. Thank you. Tom, for you, I want to go back to your little case study on Corpus Christi, because as I was reading some of the background, there was a comment made by one of the economic development folks there about an investment of several $1 billion by a Chinese firm to produce steel because of the access to the low-cost natural gas. Also a European company doing essentially the same thing. Talk about, amplify the foreign direct investment implications in the oil and gas, and Owen, you may want to lean in on that one as well. Make a comment.
Well, so I was in Corpus last week for a discussion about what's going on there, and I had a chance to talk to the city manager for Ingleside, and I asked him, he's been there 8 years, and I asked him when he came on board, did he envision any of this happening, the manufacturing that's going on, just incredible levels of it. He was pointing out to me across the bay, the Chinese steelmaking facility that was actually visible from the Corpus side, and all of the other projects going in. Most of them, the ones that he pointed out to me as a result of FDI. And he said, no, who would have thought? We were, when I got here, we were courting retirement communities to develop facilities here. And happily, it sort of went in fits and starts and ultimately didn't come to fruition. Instead, they've had this, this incredible, like I said, $30+ billion economic impact as a result of the low-cost natural gas here in the U.S. And the only reason it's sustainable is because, as far as we can tell, the price for natural gas in the U.S., even with export, is not going to, it's just, we don't see the case for it going above $7 per thousand cubic feet, which means it's now a predictable resource. We've got a 50, 100, 200-year supply of it. Even the Eagle Ford, it was mentioned the Marcellus produces 16 billion cubic feet per day. The Eagle Ford produces, and they don't really want to produce much gas there. They're far more interested in the oil, but they produce 4 billion plus cubic feet per day there as well. And not to mention the Niobrara, even the Bakken produces some. So we've got lots of natural gas here in the U.S., and that's driving the bulk of these types of projects.
Yeah, and that's what we're seeing as well. I mean, geographically, it's fairly wondrous. I mean, in some parts of Texas and in Pennsylvania, there are shales stacked on top of shales. So from the same footprint, drillers can go down and get natural gas from one shale formation, then go down a few thousand feet more and collect more gas. So the supply trends are hard to get your head around. But once the foreign direct investment companies came over here and sort of did their due diligence, they started bringing lots of investment dollars with them, and it's because they believe that the availability of shale gas in the United States is gonna be here for a long, long time. As Tom pointed out, you have 200 years worth. Just as a price point, it costs less than $400 a ton to produce ethylene, which is sort of the basic building block chemical in the United States, and in Europe and Japan, it's over $1,000 a ton. So I mean, that's a big advantage.
It's a fairly significant differential.
And it's going to last a long time, and that's why a lot of this new production is being cited here.
Okay, Eric, I want to come back to you and let you sort of wrap up here. You talked about, the portfolio shifts going toward manufacturing, understanding that you still have to have a lot of industrial because the investors and the REITs and the investment committees understand the big box. How do you see, the investment community and the development community looking at manufacturing from the standpoint of, this is a good cycle to get into. This is a place where we ought to put some of our capital, and how does the guy who's always looked at the big box and said, that's my bread and butter, I get that, get into the opportunities that are available in other markets because of growth in manufacturing?
So, quick case study. We recently transacted about a 900,000 square foot portfolio. We sold it on behalf of J.P. Morgan in Chicago. And about 30% of the occupancy of that portfolio was manufacturing. And we sold it to another institution. When we kind of did the postmortem at the closing dinner, we asked them about these manufacturers, and they came back to us and they said, look, these tenants are very sticky. We get their business. We had to understand their business first and foremost. But once we did, we understood that this is a good risk and a good bet to take. I think you're also seeing, some of the specialized assets begin to trade at a more institutional level. We're currently working on a project of assets across the country and a portfolio that are basically freezer cooler buildings, and they're in some of the major markets, and they're very specialized. But there's a lot of institutional capital that is chasing those specialized assets because they get the businesses and get the tenancy. So, as the world becomes more global but yet more specialized in how we practice real estate, I think you're seeing more of the institutions be able to get their heads around some of these unique assets.
Okay, thank you. The clock it has expired for us. Unfortunately, but fortunately maybe, we are out of time. So we're going to conclude this session. I want to thank the panel for a great input, great insight, and thought, and hopefully an input for the NAIOP members that's a little different from the tradition of investing in the big box. So we're at a break. We have a networking break in the ballroom foyer. and we'll be back here at 10:30 for the next session, which is the regulatory environment and its effect on development. Thank you very much.
A new place where the kids are